Welcome back to our FinTech series. We continue with the company profile snapshot for Scalable Capital, one of the fastest growing wealth tech investment managers in Europe. In this episode, the founders of Scalable Capital talk about how they funded their business and what key performance indicators they have in place to monitor and report their progress to investors.
Originally, the business was, but just for the initial few months, basically bootstrapped through founders' money. But then very quickly, we were able to get in money through business angels, primarily acquaintances of ours, people that they know, they work in the financial industries, that are quite senior, that fully understood right from the start what we were trying to do and why there was such a huge need for that, and why the team was well equipped to achieve what we wanted to achieve. So we got money from business angels fairly quickly on. And then we raised our first sort of A series of VC money with Holzbrink as a lead investor. There was 4 million in early 2016. And then we had another round, 2015. And then we had another round in 2016, which was another 7 million euros. So altogether by now we're at 11 million, but we're going to raise more money very soon within the next couple of months. And we are not profitable yet, but potentially the next funding round, if it's large enough, might actually bring us to profitability already.
So we've been live for just over a year in Germany and about 6 months in the UK. So we don't yet publish our performance on our UK website because we're not allowed because of regulatory requirements. For us, though, we're very happy with the results. We run risk categories from 3% all the way up to 25%, like I said. From the low risk categories into the medium risk categories, so from 3 up to 25, we're outperforming our benchmarks. From like 15 up to 20, we're in line, and from 20 up to 25, we're a little bit behind. The reason we're a little bit behind is because equities is the biggest outperformer, and in the high risk categories, traditional fund managers have a huge weighting to equities, whereas in our dynamic risk modeling world, we're shifting risk between different asset classes. So when equities, absolutely fly off the shelves, then we're going to slightly outperform. Likewise, though, in a down market, that's a time when we'll really shine. Because in a down market, when you've got 80-90% of your cash in equities and you lose 30-40% of your money, that's when our dynamic risk management system takes control and reduces the allocation into things like the riskier asset class. It's about trying to maximize the risk-adjusted return. We don't want to knock it out of the park with a huge volatility, huge drawdowns. We want to have a controlled investment process which grows over the long term, because I said it earlier, you need to make sure that investors stay invested for as long as possible. So what we think about is trying to reduce the gap between investor return and investment return, and by doing that, that's how we can make sure that the investors getting what they deserve in the long term. So far in the short history, we're pretty happy.
For me, the two key indicators that I would mention here is, number one is the AUM growth, so assets under management. How are we growing on that dimension? And that's obviously also driven by the number of clients that we have, that we are able to attract. And then I think number two is, what's the relationship to cost, and primarily the customer acquisition cost. So, it's not difficult basically to get to, let's say, 100 million assets under management spending 50 million. That's not a great success, because you've basically spent, half of the money that you're getting in, and that's not revenue, it's just assets under management, right? So you're spending half of that to acquire those people. That's obviously not a great idea, because you're never going to be able to make enough revenue with those people to even recoup your marketing investment, right? So what we are doing is we are obviously reporting, the marketing spend that we have, what we spend on PR and all of those things to acquire people. So I think that's very, very critical. So like the top line, how much is coming in, and then how much do we actually spend in order to generate that top line? I think those are probably the two most critical factors. And then probably number three is sort of, the other cost of the business. So how do we scale up our team to make sure that, we're able to deal with sort of the growth of the business, and we're well prepared, we're developing the product and so on. But investors don't get the feeling that, we don't scale well. Yeah, we need to build the team massively in order to drive growth. That wouldn't be a good message. Yeah.
We're very happy so far. Just to share some metrics, we over 150 million euros of assets under management now, and over 4,000 clients. So for only being in operation for just over a year, very happy with how the growth is going so far.
Shortlisted Productions specialise in the production of business video content for corporate clients. Please contact us for a free quote at shortlistedproductions.com.